What a day. It was a sigh of relief to see the markets bounce back today, and not just any bounce back, an aggressive and volatile bounce back after many back to back red days in a row. So, the obvious and next question on everybody's mind is this just a dead cat bounce, or is this the point where the markets have had enough and start to turn back? First, let's look at the daily charts for SPY and QQQ and see how they did today. First up, we have SPY right here. We have the daily chart pulled up. And as you can see, year to date, we're down about 17.4%. This is the daily candle for today. And we had some wild swings today with SPY starting the day around 480, going all the way up till 522 and settling the day at 504. That's a jump of 482 through 522. So almost 40 plus points in one day, and that's pretty crazy by any standards. However, it did manage to keep some of the gains, but still ended the day slightly short, ending the day negative 0.18% at 504.38. Let's look at QQQ right here. QQQ still down about 21% year to date, and if we look at QQQ's daily candle, QQQ started the day at about 402.75, went all the way up to 443 and settled the day at 423.69, up 0.24%, which is not so bad considering the last few days. So again, the question is, can the markets hold on to these gains or will it come back down? I spent some time looking at some of the previous downturns and see how long it took to recover and compare it with our current situation. A quick disclaimer before we get started, this video is for educational and informational purposes only and should not be considered financial advice. I am not a financial advisor. So looking at some of the previous stock market crash recovery times, I'm going all the way back to the 2000s with the dot-com bubble burst. In the year 2000, we had the NASDAQ index fall by almost 78% from its peak. And in this case, it almost took 15 years to return to its all-time high. Next, in 2008, we had the financial crisis with the housing bubble and the subprime mortgage market leading to a severe financial crisis. Here, the S&P 500 lost almost 50% of its value and took almost 4 years for the SPY to regain its pre-crisis levels. We all know what happened in 2020, and the 2020 situation led to economic shutdowns and market panic. S&P 500 fell by over 30% in early 2020. In this case, the market rebounded to pre-pandemic levels within just 5 months. And with the current situation, as we all know what's going on, as of today, SPY is down about 17% and QQQ is down almost 21%. The VIX is hovering in the 47 to 50% range. If you're enjoying this video so far, don't forget to like, share, subscribe, and also hit the free options newsletter link in the description box below. Next, let's look at some of the factors influencing the recovery time in each of the situations. Severity of the crash. Deeper and more prolonged crashes typically take longer to recover. Economic conditions. A weak economy or ongoing crises can hinder the recovery process. And investor confidence. If investors are more pessimistic, it can slow the recovery. So let's also look at the average recovery times, and this is coming in from Invesco. The average time to recovery from a 5 to 10% downturn is about 3 months. The average time to recovery from a 10 to 20% correction is about 8 months. So coming back to our current situation and knowing that we're almost touching bear territory or almost in bear territory, if we see a continuity of today's volatile fight back over the next few days and a possible stabilization to the tariff situation, we may see a reversal sooner than later. If you enjoyed this video, please give it a thumbs up, share it with your friends, and leave your comments below with any questions or thoughts. Thanks for watching, and I'll see you in the next one.